gonna go ahead and get started. I'll edit the quiet period out, so don't worry. And video should be available probably within an hour or two, will be my guess. But today we're gonna go over chapters 3 and 4 of Trading Price Action Trends, and of course here's a reference slide for whenever you guys either download the PowerPoint from the Discord or want to look through here. So chapter 3 talks about breakouts, trading ranges, tests, and reversals. And Al's talking about essentially like spiking channels, and he gives a little bit of nuggets here, like rarely do trends break out above or below a channel line and accelerate. I talk about this all the time when we live trade. Channels are flags on higher time frames. And a test, when he refers to a test, it can be a lot of different things. Here I marked support and resistance, right? But it could be a trend line test. It could be a breakout area retest. You break out above, I don't know, say 45.50 on ES, it breaks out. You get follow through, and then the pullback goes and retests it. It could be retesting the high of a signal bar, maybe the low of an entry bar. So it can mean a lot of different things. Reversals actually have its own book, so he doesn't talk about reversals too much in this chapter, or honestly in this book. But when he talks about reversals, he is mostly referencing a change in a trend. So technically, right, if you think of it that way, if we are trending down and we have a 2-bar reversal, or sorry, a 2-bar pullback, that is technically also a reversal, but it's a minor reversal. Excuse me. And that's why I have it subloaded here, that most reversals fail and are minor, because every pullback is a reversal. But again, they usually fail and they're minor. But he also talks about reversals just trading or changing from in trend to a trading range, which is what TR stands for, which I think is an interesting point of view. And every sharp move and strong reversal should be thought of as a breakout of something. And the reason why I included this was because of things like leg counting and things like high ones and high twos, low ones and low twos. Because if we're counting legs, whenever you break out, the count often is reset, and whenever you are counting high ones and high twos, every breakout or next leg is also reset. So he'll talk about high ones and low ones and low twos and stuff like that later on in the book, but just kind of keep this in your back of your mind when we're talking about resetting the count of those things. And then I have some pictures of the chart. This is from August 29th, and when a breakout is a spike, right? So a spike, pullback, and channel. Whenever we talk about that, or you're reading about it here, this is essentially what he is saying. So you can see that bar 3, you have a spike. I drew this blue line on the top to show that we were in a trading range on the 28th, and August 29th's bar 3 breaks above and closes above that trading range that we had. And then bar 4 is a follow through bar, with bars 5 and 6 being a pause and the spike before another breakout, and then we begin to channel. Okay. This breakout area, which I'll go into later, I'll go into it now. It's actually like another test, right? So like bar 6 right here. I know I skipped a few slides. I'll come back to them, but it's a breakout area retest. Bar 6 is, even though it doesn't quite get to it, to the tick or whatever, it's still a retest. So just one example of many different types of tests that there actually are. So going back to slide 4, I have a little write-up in case you just want the PowerPoint, but yeah, eventually we'll begin a channel, and that's actually going to be what slide 5 is about. So always remember that channels are flags on higher time frames, and bull channels tend to be bear flags, and bear channels are bull flags. And just because they break out down or up, just because they break out really, it doesn't necessarily mean that there's going to be a big reversal. It can also just mean that the reversal, right, that Al talked about here, it can also just mean from trending to trading range. This is exactly why I picked this example, is because yes, we break out and we reversed from this bull channel, but the reversal was not a bear trend. The reversal was just a trading range, which you can see from bars 29 to 66. A small, very tight trading range, but it's still a trading range. And something else to remember with channels, again from slide 3, rarely do trends break out above / below a channel line and accelerate. They usually fail within 5 bars. Really what I take that as is, in a bull channel, if we break out above, it's usually not going to be sustained, right? Usually not. Obviously it's not pictured here, but just keep that in the back of your mind as well. I talked about slide 6, so I'm not going to go over it again, but it's just a retest of the breakout area. And that brings us to chapter 4, which is bar basics, signal bars, entry bars, setups, and candle patterns. You'll see me do this a lot, or quite a bit at least, when we are trading live. The signal bars are always labeled in hindsight, and they're bar before your entry. So as the bar is forming, you cannot call it a signal bar until it's closed on whatever time frame that you have, whether it be daily, a 1-minute chart, a 5-minute chart, 15-minute chart, it doesn't matter. The entry bar is obviously the bar that you entered on, with the following bar being your follow-through bar. And Al's definition of a setup is just a pattern that can lead to a profitable trade, and if you're trading with the trend, is in the direction of the prevailing trend, and counter trend will be the opposite direction. And then the last piece being about candle patterns. Al doesn't care for naming candle patterns or whatever. He doesn't see it as a value add proposition, so we're not going to talk about it, or at least I'm not. Seems like these slides are duplicates. I apologize. Delete. So the majority of chapter 4 I think can be summed up right here. And we see August 15th we have 2 bull bars that make what would end up being high of day, and then a bear leg, and then bar 5 is a pullback bar. And when you see bar 6, it's not a big bear bar, but it's a strong bear bar because it closed near its low, and it gives you a pretty good risk to reward. You enter 1 tick below bar 6, which makes bar 7 your entry bar and bar 6 your signal bar, and you have really 2 spots to place your stop. You can place it at high of day, which I would recommend, since this is a second entry swing trade. It is not a scalp. Or you can put it above bar 5, but if you put it above bar 5, there's still a good chance that you will be stopped out. So again, it's probably better to put it up above bar 1. And bar 8 is your follow-through bar. So you have 3 bear bars, momentum, and it's just a beautiful signal bar, entry bar, follow-through bar, and you'll make money. In fact, if you want to go back and measure, which I should have done, but if you go back and measure this breakout move, it is almost 100% of the move. You eventually get it with bar 13. So it's a good breakout measured move, swing trade. And then I have some words of wisdom from Al that I like his little nuggets that he talks about. One of the most important skills that a trader can develop is the ability to reliably distinguish between a successful and a failed breakout. I'm not perfect at doing that. I think it actually is one of the areas that I need to be better at. But take slide 8 for example. So bar 7 is a breakout bar and it creates a measuring gap. It's a breakout bar because it creates a new low of day that broke a previous low, right? But it's a strong breakout bar because look at the way that it closes. It closes below bar 4 tail, and it closes with a bear body, a strong bear body, one tick off of its low. And bar 6, it's preceded by bar 6, which is a second entry sell. So it's a good probability that this trend will sustain at least for one more leg. And stuff like that where you can kind of maybe create criteria that you can analyze relatively fast, right? Because some people wouldn't take this sell signal. Some people may want a breakout and then take the retest of the breakout area, so bar 4, which is around, I'd say bar 26, bar 31, give or take one of these two bars. And yeah, if they waited all day for it, they did get another sell, as you can see. So it's just higher probability trades whenever you're able to read breakouts correctly. This was said in the previous chapters, but I mean, if it's coming up again, you know how important it is. Markets have inertia and are very resistant to change. And the last one that I picked up on was the single most important skill that a trader can develop is the ability to determine the times when there will be more buyers or sellers above or below the prior bar. So going back to this chart, if you remember from last week, there's only two types of bars. There are doji bars and trend bars. There's nothing else. So doji bars tend to have buyers below and sellers above, while trend bars, if they're a bear trend bar like bar 3, and you can see the follow through bar 4, they tend to have sellers below and above, more sellers than buyers below, because it's a bear trend bar. And of course, it's not that simple. It requires context, right? And the context here is we closed below the two bull bars of the day, and it closed one tick off of its low, so you can reasonably assume that there will be more sellers than buyers below. And buyers will wait either for a support test or a bull bar or two to form before they're ready to actually buy. Bar 5 is a pullback bar, yes, and it's a bull bar, but it's bears taking profit because they know the open is volatile, and at the open you can really only trade for scalps until bar 6. Then you can get an idea of where you want to swing. Let me check the Discord to see if anybody has any comments. Not that I can see. Okay. I'll end the video here and then I'll edit it and upload it. I'll see you.